Hello and welcome everyone. So today's session is going to be introduction on financial instruments and markets. So it'll be taken by Mrs. Neoma Pasricha. She has done her post-graduation in finance and economics from the London School of Economics. If you have any questions, you can put them up in the chat box and we'll make sure they're addressed at the end of the session. Over to you, ma'am.
Firstly, I would like to give you all a very warm welcome to the IYEA family and a very warm welcome to all of you for attending this webinar. Thank you so much for taking out time, showing your interest at the internship program, and being committed to attending this finance module. I'll give you a little structure about this week, which is that today is the introduction to the financial markets and its various instruments. And over the rest of the week, we are going to talk about the various finance instruments in detail. As already told by Kashika, I am Neoma Pasricha. And having done my undergrad from University of Sheffield in the field of economics and finance, I went ahead pursuing my post-graduation from London School of Economics in finance. Currently, I am actually looking at one of the new ventures that I've entered into. It's a franchisee model of a brand called Truefit and Hill. So that's taking up some of my time, but it was amazing preparing myself for this webinar for the IYEA family and getting back to the finance where my heart lies. Before I start, I'll let you know that this will be approximately a 90-minute long module. I'll try and complete it before time, hopefully, and I'll also be taking in all the questions that you have. As Kashika has explained, you can chat the questions and we will take it up at the end of the module. I would strongly suggest, though, because this is just an introduction module, that the rest of the week we're going to have all the topics that I'll be touching on today. We're going to cover the rest of all those topics in detail in the next week. So if you want, you can wait for your questions to be asked by our other mentors who will let you know everything in detail, or you can ask me. You can even feel free to email me your questions and we can have a one-on-one discussions about anything that you're unclear about. Kashika, can you put in the structure of the module today, please, for everyone to see? So broadly, we can say that this would be how our 90 minutes for today would look like. What all we're going to be touching at, we're going to be looking at the financial markets from different angles, different point of views. We're going to touch on various financial instruments which are there existing, some very easy, some little complex. We're going to look at the market players, basic market players that are there in the market, and also we're going to touch upon a certain kind of funds. My aim for you is not to create this as a classroom module, because all these topics that I'm going to be touching on are easily available on internet to read. It's easily available in any university in the world doing a finance module for anyone to attend and learn about it. My aim for you here is to make you understand these concepts in a very layman point of view. I will try and make you understand these concepts as if you've never touched the world of finance, and try and make you understand them that way. The ones who are not from a finance background, this module will help you understand the concepts and prepare you for the rest of the modules we are going to be having over the next week. The ones you already understand about finance, you understand the instruments, this module will be just a brush up session, or will make you understand finance from probably my eyes, or finance from the eyes of a normal layman who is not into our world of numbers, right? So let's get started. Let's start with financial markets. The world of finance is actually really complex. It goes, lots of instruments are there, lots of numbers are there. There are lots of people have their own points of views, and many people are into this business for minting money, earning. It definitely helps get a lot of commissions, and it gets a lot of, you get a certain percentage if you help get a good investor to trade in this market. So this is a very complex world of finance. But what exactly is a financial market, or let's say an asset market? I'll tell you in very simple terms. My way of giving you this module is that I will try and build on the title itself, because I'll tell you the logic is the title itself will reveal the definition of anything that we do. So, like I'm saying, it's a financial market. It's the title is self-explanatory. It's a platform. It's a platform which gives people the right, or people can sell, buy real assets, financial assets in this on this platform. You're not only selling any securities of equities or shares. I can even sell commodities. I can sell gold. I can sell coal. I can sell oil. I can buy oil. So this is a platform where you can buy and sell stocks, bonds, commodities. It's a platform that makes a buyer and a seller meet. That's as simple as that. And to think about it, it's been going on since our civilization has always started. Now it's become really sophisticated and nice, but over the years, humans have always entered into these markets. For example, let's say at the start of the civilization, there was a barter system. Barter system was like, suppose there's one person, he has 20 kgs rice, and there's one person, he has 20 kgs sugar. The person who has rice needs some sugar, and the person who has sugar needs some rice. So they exchange few kgs among themselves. They were exchanging commodities and living a life. They were surviving. Over the years, the same barter system has become more sophisticated, and we've got these financial markets into place. Now, they were exchanging commodities. Then came the money aspects. Money was invented, a basic unit to measure any economic value. It'll simplify any comparisons for wages, price, incomes. It's a unit of accounting that came into being. For everything, there became one single unit of measurement. Now, every country has its own currency, has its own money. So then came into currency exchange, that if there's a person in US having dollars, a person in India having rupees, they can exchange their currencies with the certain currency exchange around 75, 74, which is going today. That's simple as that. So financial markets became more standardized. A standard unit of accounting came, which is fair and square to everyone who's trading in this business. Okay, I don't know how simplified we made from the barter system, how simplified it became as a unit of accounting came, organized platforms came, or maybe it became more complex due to the complex instruments that came into the picture. That's for us to see, but I'll try and explain you all these instruments and all the markets in a very easy and a layman term. I'll touch on little topics to make you understand them from an easy perspective. But the basic and the golden rule of finance, I'll tell you, is higher the risk, higher the return. And buy low, sell high. No matter what trading you get into, whether you get into a forward, whether you get into future, whether you get into a swap, or whether you trade very complex derivatives like a butterfly swap or a straddle option, the basic golden rule is the more the risk you take, the more return you'll get. And buy low, sell high. When the price of anything touches the bottom, that's, if you see, that's what all our mothers and all the ladies out there do when they are bargaining with a vegetable vendor, when they are bargaining with anyone. They want to buy something at the cheapest possible price, and then they become happy. Oh, wow, 100 rupee apple, I got it for 80 rupees. Amazing. So that's the same structure. It's buying low, selling high. And when you want to sell something on OLX or anywhere, you want to sell it at the maximum price. That's the simple rule. If any time any time in your life you are dealing with any complex derivative or any complex financial instrument, remember these two rules. They'll really help you undermine the entire instrument in itself. So, to talk about financial markets, we can categorize them into various types. So the first and the basic foremost categorization that I can do is, if I want to categorize in the time of when is my instrument, or when is my instrument getting matured. So I can categorize financial markets into two categories: money markets and capital markets. To talk about money markets, now what is the name suggesting? Money markets. Money is what? Money is liquid asset, highly liquid asset. Okay, so my aim again during this course is to try and explain you these jargons of financial accounting and jargons of financial management in very simple terms so that the next 1 week becomes easier for you to understand. So what would be liquid for that matter? Liquidity is how easily you can get your money back from an asset. For example, let's say I have bought a house, right? I have spent my good amount of money in buying a house, and tomorrow I want to sell it. There is a possibility that I can sell my house. I might get a buyer tomorrow and I'll be able to sell my house tomorrow. But there might be a possibility that I might get a buyer after a month, or maybe after a year, or maybe after 5 years. I don't know how easily will I get a buyer and how easily I'll be able to convert my financial asset, which was a house, into money again. So, in that way, this real estate becomes an illiquid asset. It's difficult or it's uncertain on how quickly you can get your money back. Secondly, if I would say, if I have some amount, the same amount, I put it in a saving bank, right? Now I've put in my money in the saving bank and tomorrow I need that money. I am so sure that I'm going to get my money back tomorrow. So that means saving bank is a highly liquid asset. So that's the definition of a liquid and an illiquid asset. So money markets, then what is the name suggesting? Money. Money is the most liquid form because it's money itself. So money markets are highly liquid markets. That means it's a platform where you can trade in short-term debt investments. Usually the term lies within a year. Usually it's a 12-month term. It can be a 3 months, 6 months. The maturity of that asset would be within an year. And they're all traded on OTC. That's over the counter. We will go through the concept of OTC and listed exchange a little further down the course. But let's talk a little bit more about money markets. So money markets is basically a platform where you can trade short-term debt investments. And short-term, by short-term, I mean within 1 year. So if I'm saying within 1 year, means if you have invested, for example, I would say you've invested in a commercial paper, which is one of the instruments of a money market. If you've invested in commercial paper, which is maturing after a year, you are getting your money back in an year, right? So it's a highly liquid market. And it's also quite safe. I'm not saying 100% safe. You never know when any company can go bankrupt or anything. But generally, the people who are the issuers of the money market instruments, they have a good, strong credit rating. But to your own discretion, I would say you should check the credit rating of the issuer before investing your money anywhere. And the way the money market instruments are priced in the market are using the discount pricing. Now, what is discount pricing? We all know there is a time value of money. And that's a very common saying, money is time, money is time. In the finance world, we literally believe money is time. How is that possible? So 100 rupees next year, I'm giving you an example. Suppose 100 rupees next year is not the same as 100 rupees today. There is a time value of money. Maybe 90 rupees today might be 100 rupees next year or 10 years later. There is a time value of money. And how do we in this world of finance calculate time value of money? We use the discount pricing model of economics to do that. So we are doing the face value if we divide it by the interest rate. And if we look at a real economic world, which is perfectly, everything is just bang on, in that world, your interest rate would be equal to your inflation rate. That would be, which is never the case, by the way. Don't go by the books. It's never the case. But in the real world, that would be. So using money, there's a time value to money. So we are discounting the future money that we would get with the interest rate. That's the discount pricing. So these money market instruments are usually issued at a discount rate of the face value. That in future, if you're getting 100 rupees after a year, today you buy it for 90 rupees and the 10 rupees that you're getting is your interest rate for keeping the money with us, with the issuer. That's the whole concept of a money market. Then there's another aspect to financial markets, which are capital markets. Capital markets are basically a platform where you can raise capital by dealing in shares, bonds, any other long-term investments, which is, by long-term, I mean over a year. So basically, what I have done here is I have divided my entire world of financial markets into two categories. Money markets, which is if you're dealing with any kind of debt instruments within maturing before a year, and capital markets, which is dealing with any kind of debt instruments or equity instruments which are in maturing over a year. It can be a year and a half, 10 years, 20 years, 50 years, any amount. That would be the category of capital markets can again be divided into two categories: primary markets and secondary markets. Now, what are primary markets and what are secondary markets? What is the name suggesting? Primary is the first thing. Like, when a child goes to a primary school, that's the first step the child is taking towards learning. That's the same thing, the same concept, just put it in the world of finance. Primary market, when any investor, any issuer is taking a first step to enter itself in the world of finance, has to go through the primary market. It's a part of that capital market that deals with issuing of new securities. Suppose there is a company and that company needs a lot of funds now. Okay, it's a growing company owned by a good family, and now they need funds. They don't want to get involved in a lot of debt. They want that someone is ready to take a certain percentage of their company in return of the money that they get. So they say, fine, we'll sell our equity. Equity is basically the holding percentage that the family has in the business. It's how much percentage that I own in the business. So this company is this family is ready to sell a certain percentage of its company to the public. For that, it has to enter into the stock exchanges like NSE, BSE, everything. But to enter into the stock exchange, NSE, BSE, you have to go through a primary market. That's the market where this company would want to go itself first in order to have its shares listed in any stock exchange. It's a part of the capital market that deals with issuing of any new securities. Companies, government, public sector institutions, anyone can obtain funding by selling their shares or even bonds. If the company wants to issue bonds, which is a debt instrument, I'll go over the instruments further down the lecture. So if the company wants to sell its bonds or shares, for the first time, it has to go through primary markets. Primary markets are where the securities are sold for the first time. It's also called the new issuance markets. And there are various ways a company can issue its securities: through initial public offer, further issuance of capital, rights issue, first firm allotment, offer to public. I'll go over all these concepts when we'll be going to the second part of our lecture, which is on instruments of the financial market instruments. The second part that we divide our capital market is into secondary market. Secondary market, the name is suggesting secondary. It's coming after primary. So it is a platform here where the buyers and sellers are selling the security that they already own. So primary market is the time when the first time the buyers are buying the shares of a company that is listed through an IPO. That's happening in the primary markets. Now those shares are already out there in the market. So what's happening? There's a certain X person and a Y person. The Y person has shares of, let's say, Reliance, and the X person wants to buy it. So the Y person can sell it to the X person. Where would they do that? They would do that in the secondary market. Stocks are mostly traded in this market, but it's not that only stocks can be traded. You can buy, sell mutual funds also. You can buy, sell commodities also. You can buy, sell anything. It's not just for stocks. You can even buy, sell bonds, I would say, which is a debt instrument here. The secondary market investors exchange with each other the securities which are already issued and are available for the public through primary market. And how are the prices determined in the secondary market? You remember, or those of you who are not from the economics background, I'll give you another. I should have added another golden rule, that the demand and the price, they are always proportional to each other. They are linearly upward sloping curve they have. If the demand increases of something, the price will increase. That's a simple rule of economics, right? So in the secondary market, the prices are determined by the demand and supply curve. So it's the intersection where the demand and the supply curves are meeting. That's the price of the security. The supply curve is a downward sloping curve when it comes to, if you're making a chart with the price and the quantity, the supply curve is a downward sloping curve and the demand curve is an upward sloping curve. So where they intersect is where the prices of the security would be determined. So in a secondary market, the prices are determined by the demand and supply. So let's give an example. Let's give an example of a fruit seller only. The fruit sellers that come every day in front of our houses. He's got a lot of oranges, right? So if all the aunties out there in the colony are ready to buy the oranges, he'll say, 1 kg oranges of 100 rupees. Now my price is 110 because there's a lot of demand. But at the same time, if no one is ready to buy oranges, he'll knock on every day and say, please buy my oranges for 80 rupees. That's the same concept you can see in the secondary market. If the demand of that particular security is very high, the price will automatically increase. If the supply is very high, that is, if a lot of people want to sell it off, they want to short a certain thing, the prices will fall down further. But in a primary market, the prices are predetermined. They are predetermined by various factors. When, for example, when an IPO is getting done, there are a lot of underwriters, a lot of bankers working and looking at the market, looking at the various factors to determine the price of the security that they want to issue in the primary market. So in a primary market, the prices are beforehand set. But in a secondary market, the prices are set by the demand and supply curve. And in both the markets, I would say, internal and external factors do affect the prices of commodities or stocks. In a secondary market, the external and internal factors will directly impact the price. But in a primary market, the internal and external factors will help the company, the underwriters, the banks to come on a proper conclusive conclusion of a certain price at which they think that the market will accept their security. Right? So this was basically a broad overview of the financial markets and how we can categorize them into money markets and secondary markets. Secondary markets can further be, money markets and capital markets. Capital markets can further be classified into primary markets and secondary markets. And secondary markets are basically, I would also say, can be divided into OTC and listed exchange. Let's get into that a little in detail. Before that, let me give you a very simple example. Suppose there's a glass of water in front of you and it is half filled. There is one person who's seeing that glass of water as half filled, whereas there's another person who's seeing that glass of water as half empty. But the glass of water is still the same, right? It's still a half-filled glass of water, however you can view it. Similarly, we can view this financial markets. It's a big chunk of a brownie that you can think. It's a big chunk of brownie, and you can see it as, you can divide it into two pies. One is a money market and one as a capital market based on when the securities are maturing. Secondly, you can also categorize, or you can complete that entire brownie into a pie. You can divide it based on the instruments that that market is giving. If it's a debt market, or it's an equity market, or it's a hybrid market. So the chunk is the same. My point of view is different. First, I was looking at it from a point of view of when is my security going to be maturing? When is my instrument going to be maturing? So that's why I categorized into money markets and capital markets. Now, if I want to also look at when or how can I trade in my instrument, I can categorize them as into an over-the-counter or listed exchange market. Or if I want to categorize I can also categorize the same financial markets into a debt market or an equity market, depending on which security I want to trade in. So the chunk is the same. It's just the point of view of how you want to look at the entire model of financial market and how you want to categorize it. So another way that we can categorize the entire financial markets is an over-the-counter exchange or a listed exchange. What is an over-the-counter exchange? An OTC, that's a big jargon that's used in financial module, any module. This is an OTC instrument. This is a listed exchange instrument. But what does OTC actually mean? OTC is over-the-counter. Now, I told you my way of explaining to you is even a layman should understand these jargons. I would want you all to go with this course with understanding these jargons of finance in a very easy, simple terms. So what is an OTC, over the counter? Let's give an example. I'll again use a daily example that everyone would be familiar with and connect it to the world of finance. Guys, trust me, the world of finance is very easy, and you can easily connect it with your everyday lives. It's just we have these complex jargons to make it look really nice and sophisticated and good. And also, it's a way to sophisticated, good, and also a way for brokers to earn their commissions and money, because we always talk about money here. So coming back to the point, let's talk about OTC. What is over the counter? Suppose I am not feeling well and I want to go and get a tablet of Crocin. I go to the chemist. Everyone's been to a chemist, right? There is a counter there and there's an uncle behind the counter asking, and we ask him, can you please give me a tablet of Crocin? So there is a counter. On that counter, he puts Crocin, and I put my money. I take my Crocin. He takes my money. Transaction done. Guys, trust me, financial markets is as simple as this. This was nothing but over the counter. And that's what we do in finance. It's over the counter. It's a transaction happening between two people, which is happening over a counter. Maybe over a counter, or maybe over a coffee. Whatever that you may take it into. So now if I want to give you a little sophisticated financial definition of it, it's a decentralized platform which is comprising of participants engaging within themselves with any transaction, right? So it's a decentralized platform comprising participants to engage in trading. Simple as that. So the transaction that happened between the chemist uncle and you was an OTC transaction of the world of maybe chemists. But in the world of finance, it's as simple as that, a transaction happening between two people. So it's basically the chemist person and me, a transaction happening between both of us, maybe for any instrument. I would say, for example, a forward or a future, a forward, because that's an OTC instrument. A transaction happening between both of them would be an OTC, over the counter. As simple as that. But what is happening in an OTC? There are no regulations. It's a decentralized platform. So it's happening over maybe dinner, over a board meeting, over literally a counter. So because it's a decentralized platform, which is engaging in a trading between two people, there is no regulations. There is no regulations to ensure there is no counterparty risk. There is no risk of default. So as a result, in an OTC transaction, the risk of default gets very high. Now, what is a risk of default, or what is a counterparty risk? Counterparty risk would be, let's say, a very simple example. I would say you have promised your friend that you're going to see a movie with him tonight, and in the end, you don't turn up. As simple as that. That is what counterparty risk is. You've entered into a trading transaction with another person, and that person runs away, doesn't pick up your calls, defaults, your money is stuck, or even if your money is not stuck, but the promise that you had made and in your mind you had gained from that promise, that is not happening. So this is a very common problem that happens in over the counter, because there are no regulations. There is no organization like the SEBI in an over counter transaction. So the counterparty risk is very highly high in this kind of a case. Foreign exchange market is a very fine example of over the counter. I can even give you that as an example. Suppose you are planning to go to USA for a holiday. So what happens is you maybe you know a broker around, or maybe you know a company that gives you that helps you with the exchange rate and gives you your currency. So you contact that company or your broker. What happened is you took your X number of rupees, maybe I would say, okay, you took your 100 rupees and you went and gave it to the broker. In return, the broker gave you X number of dollars. For example, if I say that it was a 10 rupee dollar for every 1 rupee, so now you've got, for 100 rupees, you've got $1,000. Sorry, for 100 rupees, you have got $10, I would say. Now, so that is what has happened. So this is a fine example of foreign exchange, of an over-the-counter transaction. It was a very fine example. You entered with a transaction with the broker asking for US dollars. You gave your rupees in return. He gave you dollars in return. This was an over-the-counter exchange that happened. Foreign exchange market has over-the-counter transactions that take place very regularly and very highly. Now, in an OTC market, there's a lot of competition also. So as a result, the volumes are also very high. So the security prices can differ from seller to seller because it's not a centralized platform. It is not a regulated platform. It's a very decentralized platform, and each one to its own. So it is your prices can vary from the seller to seller. It's the same thing. If there are two people, two fruit sellers selling oranges, one would want to attract buyers, would lower down the prices of oranges. That's the same thing that goes in over-the-counter instruments also. The prices will vary from seller to seller because the seller wants to attract customers. That's as simple as it can get. So it's a platform where the buyers and sellers arrive at an understanding at what rate they want to trade their securities at, when they want to trade the securities, and what would be the bidding price of the offer. As simple as that it can go. Now, that was over the counter. The other kind of financial markets can be a listed exchange, commonly stock exchanges, but it's not always stock exchanges. We have exchanges, we have commodities exchanges also. We have proper centralized platforms for exchange and trading in commodities like oil and gold also, right? But let's talk about listed exchange. So these are centralized platforms where your security trading can take place. There's a proper contract between a buyer and a seller. There is a standardized quantity, standardized price, standardized timeline. You choose you choose which of these contracts you would want, and you trade with the person, right? There are a lot of stringent regulations in these security tradings. In India, there is SEBI. And the example of such platforms in India can be NSE, BSE, Bombay Stock Exchange and National Stock Exchange. So a stock exchange itself acts as a guarantor, and the counterparty risk is almost non-existent. Guys, I am telling you the counterparty risk is almost non-existent. I'm not telling you it is not existent, because you never know when a company can get bankrupt. There can be possibilities. Never say never. There is a possibility that you have invested or you have bought shares of a certain company. Jet Airways was a very fine example, right? Suppose there was a person who had invested, like who'd got 10,000 shares of Jet Airways. Now it became bankrupt. The price of the shares fell. The person lost his money. Very much possibility. Don't live in a world that there is a stock exchange, it's regulated, SEBI is there, my money is secure. No. If you want your money secure, banks, public banks. I'll get back to that. I'll get back to where my money is secured at. But I would say stock exchange is a guarantor. What we are comparing stock exchange is to an over-the-counter exchange. And over-the-counter se to stock exchange is much better because there is a regulation, there is SEBI there. We have a very centralized platform. So the counterparty risk, the risk that the person will default or run away with your money is less. If the person is running away with your money, we have courts, we have laws that will deal with them. Maybe you won't get your money, maybe you have to fight a case, but at least you have a contract that you can rely on. So as compared to over-the-counter, stock exchange is much better if you want to keep your money secure, right? So such safety net is obtained via high transaction costs are being levied on instruments in the form of commissions and exchange rates. So this is a platform where all the brokers are earning their money. So they are giving you the safety net. They are saying, fine, it's a centralized platform. It's everywhere out. The news of a certain company, which is already listed, the financial news, it's all out on the various newses like Bloomberg, Reuters, everywhere it's out there. So you have got your money in the right place. But against that, then what will brokers do? They will be charging their commissions, or they will be charging their exchange fees. And that's where they are earning their money. That's a little, but I would say that if, unless and until you know a person about from generations and you know that person will not default your default his word, then you might go for an over the counter instrument with him. But if you're not sure about who the person is and you enter into an agreement with the person, then definitely coming in a centralized platform is a much better bet than going on over the counter with him. And you might have to forego a little bit of your money in terms of commissions and exchange fees, but I think it's worth the risk. So that's all about the OTC and the stock market, right? Now let's talk about if I want to divide the same chunk of my brownie, that's the financial markets, into various instruments that it deals with. Suppose I am dealing with derivatives. I might go into a derivative market. I might go into forex market if I want to deal with currency exchange, or I might go into commodities market if I want to go deal with commodities, right? So the chunk is the same. You still have to go through primary platform. You still have to go through secondary platform. But I have categorized the financial markets as per the instruments it's dealing with. For derivative markets, that's one of my most favorites and closest to my heart, derivatives. So that will come with when I'll be explaining you the instruments. Which is when I'll be explaining you the derivative instruments, I'll come with derivative markets. Forex market, I can highlight a little about is that it's a place where the participants can buy, sell, exchange, or even speculate on currencies, right? So it's anyone, banks, companies, central banks, investment banks, hedge funds, retailers, investors, anyone can participate in a forex market. It is not denominated by one single market exchange, but it's a global network of computers and brokers all around the world trying to fix a certain currency rate between any two currencies. So here in the forex market, the forex brokers, they are the money makers. They are the ones that are with the bid prices and the ask prices of the various currency pairs. They are the ones determining, the exchange rate. And approximately $5 trillion of trading activity turnover is happening on this platform. So this is about a forex market. Now, if I want to also, I can also suppose, I feel that the oil prices are going to go up in future, looking at the oil war that's happening between countries and all. So I want to trade in oil. I want to buy a certain commodity. I want to buy a contract which says that I'll be able to sell oil at a future price because I know that the prices will increase. So for that, I can enter into a commodity market. So a commodity market is a physical or a virtual marketplace for buying, selling, trading any raw or primary products. Physical means you can literally, if you wanted sugar, you can literally exchange it, but they're also virtual. These days, in olden times, in a good time era when the world was really simple, there was a physical transaction that used to actually happen. Guys, it actually happened. But these days, we have more complex forms. We have these contracts where the actual trading is not happening, but the monetary trading is happening. We are trading the net gain or the loss, right? So that's why I say it's a physical as well as a virtual marketplace. Nowadays, even money is also in a virtual form like cryptocurrencies, for which Ajay is a master at, and I'm sure there will be a module where he'll be telling you about cryptocurrencies much in detail over the next week. So stay tuned for that one. So commodities are split into two kinds of commodities, soft commodities and hard commodities. What would hard commodities be? Hard commodities would be typically natural resources, as the name suggests. As I told you, I'll be going on with this module looking at what the name suggests is how I'm going to build on the material of the particular word. So a hard commodity would be natural resources like rubber, gold, oil. Soft commodities would generally be agriculture or livestock like wheat, coffee, sugar, soybean, pork, etc. So a commodity market will involve you buying, selling, or even trading a raw product such as oil, gold, coffee, right? So that's what as simple as it can be, right? Investors will gain exposure to commodities by investing in companies that have exposure to commodities or investing in commodities directly via future contracts. So you can invest your exposure to a company that is trading with it or directly on that commodity, whichever way. They are complementing each other. If the commodity prices rises, that company's shares or the company's credibility will also rise. So wherever you invest, either through that company or directly, if you think the prices will increase, these two things are complementing each other. Or however you want to catch your nose, straight or behind. Because the point is you're still going to catch your nose. In US, the major commodity exchanges are Chicago Board of Trades, Chicago Mercantile Exchange, New York Board of Trade, New York Mercantile Exchange. So what does that mean? That commodity markets, commodities in this commodity market, you can again trade via over-the-counter through forward contracts or via centralized platforms with regulations, but where you have to pay commissions, that is through a listed exchange. So we have proper exchanges for commodities also, like Chicago Board of Trade, as I explained to you. So that's all about the various kind of markets that exist, right? So I'll go over that before we go on to the second part of our module, which is discussing financial instruments. We have a big financial market, which is a platform where you can trade, deal with almost anything, any instruments. We can divide it into money markets. We can divide it into capital markets. Capital markets can be further divided into primary, the initial markets, the initial push required for your raise. And once you're in the race, you're in the secondary market. Generally, money markets have mostly all the money market instruments are over-the-counter instruments, but secondary market instruments can be over-the-counter, that is through a counter you're trading without a centralized platform, without any regulations, or through a proper listed exchange, which is going through a set of format, rules, regulations, and through proper quantities, prices, times, everything predefined in your contracts. And not fulfilling your contracts, you can be, a case can be done. A person can be sued for that, right? So secondary markets can mostly be, OTC as well as listed exchange. Primary markets are generally a listed exchange because that's the push required by companies or by financial institutions to enter into secondary market, to enter into listed exchange is when you go through primary markets, right? Then we have the same, if I look at the financial markets, I can also divide them into based on the instruments like Forex, like derivative, like commodities. Commodities can again be traded OTC or exchange. Derivatives can be again traded like on OTC or exchange. Forex also, Forex is mostly OTC and interbank. Exchange also, but not much. Much doesn't happen there. Now let's come on to the instruments. What are these instruments that I've been talking about that are, throughout I've been explaining you about financial markets, and I've been telling you, you can trade on an OTC platform, you can trade on a listed exchange, you can trade in a money market instrument. But what am I trading? What is it that I can trade with another person? That's where I'm then talking to you about the instrument. What are the things that I can trade? What are the things that you can go and say? You don't need to just trade on shares. You just don't need to say, I want 100 shares of Reliance. You have better options today. Literally, you have options today. You can go and trade on a call option of a Reliance share, is what I'll be explaining you now. What are the things you can trade on financial markets? This way, I'll again go through these instruments, again, how I structured the financial markets. I divided the financial markets into money markets and capital markets. So let's talk about the instruments, or what are the things that I can trade on money markets. There are many. To be honest, there are a lot of them, but I am going to go through only a few of them which are very common, which are the basics of any complex instrument. So if you know these basics instruments, then your brokers who come and use these fancy words like, you know what, you should invest in a straddle, you know what, you should invest in a butterfly swap. If you understand these basics, you can draw a diagram of a butterfly swap, which actually looks like a butterfly, and understand what it is. You can draw a picture. You can diagram a picture of a straddle and understand if you have these basic main securities on which your other securities, complex securities, are built up. So because this is just one module, I'll just highlight on few of the instruments today, and over the next week, I have these very interesting and very intelligent mentors who will tell you the details of these instruments and how interestingly you can trade these instruments in what markets, and how you can also earn your money during this time of coronavirus. So for that, guys, stay tuned for the coming week. Coming back to where I was, let's talk about money market instruments. There are a few. I'm going to highlight on the basic first four, the ones which are very common: Treasury bills, certificate of deposits, commercial papers, and repurchase agreements, or we can say reverse repo. Let's first talk about Treasury bills. Wow, the name sounds so interesting, Treasury. It just reminds me of a treasure hunt where, you know, there's a big wooden box and a lot of gold inside, and that treasure hunt is what I'm looking for. Well, as the name suggests, that's something what you're looking for in a treasury bill, but not oodles of gold, but a little bit of gold, I would say. I'll explain you why and what I mean by that. So treasury bills are issued by the central government. They are bills which are issued by the central government, and they are the safest money market instruments available. Why would I say they are the safest money market instruments available? Because they carry zero risk of default. So I would say, see, anything can happen in this world. Economies can crash, companies can go bankrupt, financial institutions can go bankrupt, but there is one institution that would be fine and will also always be running, and that is our government. That's our government. That's that institution which is always safe. Please don't consider things like a war is going to happen or the country becomes unstable. Then I have nothing to do. Then I'm sorry, the government won't also exist. But let's take a simple scenario where the countries are stable, where my country, India, is stable. Then I'm very much sure that my government, my central government, is also stable. So anything in the world can go bankrupt, right? But my government of a stable country, let's not get into wars and all, people, please, but of a stable country, the central government will always be there. And the central government is always backed by the central bank, which is RBI, which can print money. So your money is safe with the government or with the central bank always. So that's the reason I would say that that these treasury bills have a zero carry risk. Let me explain you this concept in a very easy term, I would say. Let me put is, I have 10,000 rupees and I want to do a fixed deposit in a bank, right? So me, I'm a very risk-averse person, by the way. So I will always choose a public bank over a private bank. There is an HDFC where I can put my 10,000 rupees, and there is a SBI where I can put my 10,000 rupees. I will always go for an SBI. Why? Because it's a public bank. It's backed by the central government. No matter, I'm sure HSBC, touch wood, I work there. I'm sure nothing's going to happen. But you never know what will happen. Something can happen and the bank might collapse. We've had examples in 2008 financial crisis. We've had Lehman Brothers. We've had a lot of other examples. So banks can crash, but public banks, right? And I'm taking a simple scenario. People don't complicate it with wars and fights and all. Things can happen. Public banks can also crash, but the probability of a public bank crashing is close to zero. So that's why I feel personally, my money is safer in a public bank. But as I explained you, the golden rule of finance, higher the risk, higher the return. So if I know my money is 100% safe, a fixed deposit in a public bank like an SBI, so what would be the return? It won't be what an HSBC would be offering. I'm sure there'll be a percentage or half a percentage difference between a fixed deposit of 5 years of an HSBC to a fixed deposit of 5 years of an SBI, because of a little bit risk factor also involved, right? So Treasury bills, in that case, they are bills issued by the government, very, very, very safe, like a public bank, like the FD example. So if you are like me, who likes your money 100% safe, and who likes that money, you're not ready to take too many risks, then Treasury bills, a public bank fixed deposit, these are your safe options. So Treasury bill is issued by the central government, and they are one of the safest money market instruments. There are other money market instruments also available, but these are the safest because there's a zero risk of default as they are issued by our central government. But again, the returns on them are not very attractive. That's why I told you the treasure hunt. When I'm talking about a treasury bill and I see a box full of treasure, I will find treasure in that. I will find a little bit of money, but not very many, too much of money. Why? Because the return on them is not very high. It's little. Why? Because it is the safety of them, the risk of default is very less. So the return of your money depends on two main factors. Any instruments you take, and going forward, the rest of the slides, when I talk about complex instruments, any of these instruments that you take, these instruments have a certain return. There are two very basic factors that impact. There are a lot of other factors that impact the return of the instrument, but there are two very basic factors that that affects the return of the instrument. The first is the time factor. How long is your money put in that instrument? How long have you kept that money? Maybe if you've taken a mutual fund for 5 years to a mutual fund for 1 year, your money, the return would be higher in a 5-year mutual fund than a higher in a 1-year mutual fund, just because of the timeline. And timeline, as I explained, there is a time value of money. So there is a discount pricing mechanism that goes to calculating these principal amounts, these notional amounts, and the interest that you should get on them. So there's a time value of money, and there's a risk factor, the risk of default, how credible the organization is, and a lot of other factors are there. But these are the two basic factors that determine the return on any investment, the time and the risk. In Treasury bill, as I explained, Treasury bill is a money market instrument. Money market, the first thing that comes in my mind when I say money market is that the maturity should be less than a year. So the timeline is not that big. It's just the Treasury bills can be for 3 months, 6 months, or max to max an year. So that's the timeline. So timeline is not big, and it is issued by the central government. Means it's one of the safest commodities available in the world. There's a zero counterparty risk. So both the things are very safe. As a result, the return on them are not that attractive. But someone who's okay with just having a little bit of return, or as opposed to taking a lot of risk and having very high returns, this is a very suitable instrument. And once these instruments are down there in the market, you can circulate them through a primary or a secondary market. That is as simple as I can say. I took from the central bank government, I issued a treasury bill of 3 months. Now, after 3 months, I need my money back. After about 1 month, say I want my money back. I'm going to ideally get my money after 3 months because that's when my treasury bill is matured. But I want my money now after a month. So I can go to a secondary market and I can trade for it. I'm 100% sure that I'll find a buyer to buy my 3-month bill. As simple as that. So these treasury bills can be traded as circulated. I wouldn't say traded, it's circulated in the primary or secondary market. They are issued by the central government at a lesser price than the face value. So the interest earned by the buyer is the difference between the maturity value of the instrument and the buying price of the bill, which is decided with the help of bidding. So again, for example, if I take a US or even in India, generally the denominations face value is what the value I'm going to get of that instrument at the time of maturity is the face value, because that's the face of the instrument. So in a treasury bill, I'm going to get 100 rupees after a year. I've taken a treasury bill with the face value of 100, means I'm going to get 100 rupees after a year when that treasury bill expires. Today, I buy that bill for 90 rupees. So 10 rupees is the interest, or I wouldn't say interest, it's the return that I've got on that treasury bill. That's as simple as that. There's no complex compound interest, no complex simple interest factor. It's a very simple discount value of money, discounting cash flow mechanism used to decide the price of the treasury bill. The face value of these bills are always predetermined. The bidding price, the price by which you want to buy, will always be less than the face value, so that the difference is what you earn on them. And the bidding will vary depend on how much demand of it is on in the market, right? Currently in India, there are three kinds of treasury bills: one for a 91-day, one for a 182-day, one for a 364-day treasury bill. The second kind of money market instruments that I want to give a little bit detail on are a certificate of deposits. So these certificates of deposits are just a deposit receipts of money which is deposited with a financial organization or bank. So any organization, financial institution, or a bank can issue these deposit receipts, and any person, whether it's a whether it's an individual, whether it's a company, whether it's a trading group, anyone can purchase these certificate of deposits. But they are a little different from fixed deposits. You know, in the banks, what you hear is fixed deposit, locking your money for a certain number of years. The thing is that CDs are only issued for a large sum of money. There is a certain minimum money that you have to enter into a CD. And secondly, you can negotiate a certificate of deposit. Fixed deposit is by a bank. There are terms. It is a certain rate, percentage, number of years, everything is defined. But in a certificate of deposit, I can sit with the financial institution, with the financial institution or bank, and I can negotiate the terms which suit both of them. There's a trivia of this. Let me tell you a small trivia. It was first announced in 1989 by RBI that the certificate of deposits have become a preferred investment choice for organizations in terms of short-term surplus investments, as they carry low risk while providing interest rates which are higher than that provided by treasury bills and term deposits. That's because treasury bills, certificate of deposits are issued by financial organizations and banks. They have to make it a little more attractive. They'll be higher than treasury bill rates for a simple reason: government cannot default in a stable country, and financial institutions can. So if a person is taking a risk, though in 1 year, I don't think so any bank will, looking at the current scenario, in a year, no bank will default. But you never know, 2008 financial crisis can hit anytime, anywhere. So there is a risk of default. So they will be giving you a little, not very, but a little attractive rate, because the timeline is all still under 1 year. Again, these are very liquid. Any money market instruments, whether it's certificate of deposits, commercial papers, money markets, they are very highly, they're highly liquid. And they can be issued by individuals, trusts, companies, corporations, associations, NRIs, anyone. Another common term that you will always hear in a money market platform would be commercial papers. Please issue a commercial paper. Please issue a promissory note. What are commercial papers? Similar to certificate of deposit, yet a little different. These are unsecured. There is no collateral on them. They are short-term promissory note, which is issued by highly rated companies for the purpose of raising capital to meet their requirements directly from the market. So there is a certain company, let's say there's a textile company, and it needs funds. But it knows that it needs to bleed for this year, and it knows that after the year, once the operations are stable, it wouldn't need that much money. And it knows that it can generate their money. So what it'll do is it can issue a commercial paper to individuals requesting for money for about 270 days, and in return give them a certain interest rate. But There will be no collateral, it's unsecured, nothing. It's just a promissory note. So that's why when you enter into a commercial paper contract with anyone, make sure it's a very highly rated company that you know it can't default. The purpose of these companies would be to raise capital so that they can meet the requirement and they don't have to go through a bank, requesting a bank for money just for a year. They can just issue a commercial paper to any individual, take their money after the maturity period, give them the money with the interest. There's generally a fixed maturity period that is lasting between 1 day to 270 days. And it's popular in India as well, but it's highly popular in Japan, US, UK, and many other countries. They will promise you, the reason they are a little more attractive than Treasury bills is that they will promise you higher returns as compared to Treasury bills. But at the same time, remember, they are not secure. There's no collateral. You are giving money to that company, though for a short period, just based on its rating. And they are very actively traded in the secondary market. So anytime you want to find a seller for your commercial paper, I'm sure in the secondary market, you will find an individual or a company who's ready to trade with you on that commercial paper. So these are the few kinds of money market instruments which are very common. Commercial paper is again a discounted paper, whereas a certificate of deposit, you will get an interest on maturity. So those are the little difference, that you are discounting the value of money or you're paying an interest on them. Means effectively the same to a layman, but these are the jargons that we use in this world of finance that we live in.